Hello and welcome to Portfolio Matters Weekly Update Week 24, and it's been a very eventful week in the markets. Before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what's in the update this week?
Okay, so it was an eventful week, lots of data, and but first of all, it was the FOMC meeting, which had quite large effects on markets. So the FOMC basically did nothing, but they talked the rates up from 2023. So, in 18 months' time, essentially. And they said they were talking about the end of tapering. So the bottom line is the market is now expecting 2 hikes in 2023, which is a long way off. And as regular viewers will know, we are seeing signs of inflation everywhere. And the bottom line is the Fed is going to talk about doing stuff, but it ain't going to do anything soon. But despite that, rates had a big spike, and the US dollar has had a sustained spike, which has caused sell-offs in lots of the commodity markets, as we will see. Okay, so statistics coming out this week. We had UK inflation numbers, which once again beat expectations. CPI was 2.1%, up from 1.5% in April, and beat expectations. Expectations were at 1.8%, so that is quite a substantial beat. Inflation pressures are building. UK RPI was 3.3%, again up from April's 2.9%, but that would met expectations. Now, we're getting negative economic surprises, and UK retail sales in May actually fell by 1.4%. In April, they grew by 9.4% month on month, and the minus 1.4% in May missed expectations, which were for continued growth of 1.6%. And in addition, the UK unemployment count actually crept up. New claimants were up 92,000 on the month, compared with expectations of 62,000, and that's substantially up on April as well. Moving to the US, again in the US, negative economic numbers. So retail sales in May actually fell 1.3%, and economists were actually expecting a fall in May, but the fall was larger than expected. Producer price inflation rose 6.6% year on year in May, compared to 6.2% in April, and again beat expectations. The one good piece of good news in the US economy was industrial production was up 0.8%, and that beat expectations of 0.6%. Housing starts in the US remained strong. They were up 1.57 million, but that slightly beat expectations. US initial jobless claims rose. They were up 412,000 against expectations of 360,000. So you're seeing a pattern of quite a large number of negative economic surprises, but with inflation also continuing to run hot. And talk about inflation, EU inflation in May was 2%, so on target. And Chinese industrial production year on year was 8.8%. Now, these are very difficult to interpret because, last year, the comparator, 2020, is difficult. But the key point is it slightly missed expectations of 9%. So let's look at some of the charts relating to that. Now, this chart shows the US 10-year bond yield on a 3-day view around the FOMC meeting. You can see in the aftermath of the FOMC meeting, it shot up and then it's drifted back down again. And this is it on a 5-year view, where that is just a blip, essentially. And the bottom line is that the market still believes that inflation is transient, but the Fed clearly has a lot of power in controlling the narrative.
So Keith, I think the Fed is trying to manage interest rates by talking about them, not by changing them, aren't they?
Absolutely. And this is UK unemployment rate, which is coming down, but actually more slowly than you would expect, actually. And in the US, I mean, I find this really astonishing that it's the shape of this graph. I mean, it's really flat, but we're seeing a big spike in job openings. And why isn't this coming down much faster? So I wonder whether this is unemployment benefits in the US, which continue until September, that low-paid workers just simply would rather stay at home on benefits, frankly.
One of the things about the UK unemployment rate, Keith, is that we also have there are fewer migrant workers working in the UK now.
Yeah.
And despite that should be creating job openings for the indigenous population, it doesn't appear to be doing so at the rate one would expect.
Yes, of course, we do have continued lockdown, which is going to impact hospitality. But I completely agree with you, Richard. Somebody who's recently tried to get hold of a builder, almost impossible. And this is US housing starts, which missed expectations, but that looks very strong compared to history. If you look at, pre-COVID recession, that's a strong number. Okay, moving on to other charts that caught our eye this week. Now, this chart I thought was really interesting and explains why the market is relaxed about inflation at the moment. And it shows the median price component in the CPI basket. So rather than taking the mean of all the components, it takes the median. And what it shows is the median is not showing much inflation. So that means that the inflation we're seeing is being caused by outliers, such as lumber, which is showing very strong inflation. But actually, the great mass of CPI components actually are not seeing much inflation.
Yeah.
But okay, so this is a chart of US inflation, and the Fed has said that it will now go for average inflation targeting. And what this chart says is that if you look at the average inflation since 2009, then US inflation has undershot that consistently. And so to get back to a target of 2% inflation since 2009, you can let inflation run hot at 3% for the next 4 years.
So this is undoubtedly true because it's a mathematical equality, isn't it, Keith? The problem, of course, is if you're at the bottom end of the economic ladder, then higher rates of inflation adversely affect you to a far greater extent than the people at the top of the ladder. And so from a social point of view, I think to say, well, we're going to allow inflation to run and to be dishonest effectively about the effects of it is immoral, because it doesn't acknowledge the damage it does to people at the bottom end of the economy.
Well, I would just say that this is very convenient for the Fed. It allows them to intellectualize why they're allowing inflation to run hot, basically.
Well, it does,
And
but they intellectualize it. They intellectualize it in a bubble which isolates themselves from any social consequences. But of
yeah,
course, their role actually, well, of course, their role is becoming broader and broader, isn't it? But fundamentally, their role is to ensure the stability of the banking system. Yeah, so this is the Bank of America survey of news-based inflation signals, and in fact, it's the highest it's been since 2008, and it has shot up. This, of course, reflects people talking about inflation in articles. It doesn't actually reflect inflation, but it reflects concern about inflation.
but this is important because as people become more concerned about inflation, they start demanding wage rises to keep up with inflation or get ahead of inflation, and inflation then becomes embedded. So this is important.
I think there appears to be an argument going around that inflation isn't going to take a grip because wage inflation has to get a grip in order for inflation to become embedded. But of course, we are actually looking at significant labour shortages in a number of sectors, and you're mentioning of not being able to get a builder for love or money is an indication that there is incipient inflation in the system because there are certain skills that one can't get. I also think the migration issue is more significant certainly for the UK, because if we can't get workers from Eastern Europe to do the menial jobs, they will have to be done by the indigenous population, but they won't do it at the current wage rates. So I believe that there is going to be strong wage price pressure coming through over the next 12 months.
Yeah, no, I agree with you, certainly in the UK.
Yeah, and of course in Eastern Europe, you'd expect the opposite to pertain, and they would have deflationary pressure as more workers remain where they are.
Yes, very true. But certainly the bond market is buying the Fed narrative that inflation pressures are transitory. So if you look at on the x-axis, it's core inflation. On the y-axis, it's treasury yield. And normally you would expect high inflation to equal high yields. But in this case, high inflation equals low yields.
And of course, the problem with this graph, Keith, is you have to believe implicitly that the Federal Reserve has no intention and never would and never has manipulated interest rates at all.
Now, going back to wage inflation, this is US numbers, and it's showing that job openings, which is the blue line, now exceed unemployment. So that means that US workers should have pricing power. And as a result, wage inflation shows the first signs of picking up. Watch this space.
Yeah.
Richard.
This is the employee quits rate. And it's predicated on the fact that employees tend not to quit their jobs when there aren't many jobs available, and that when there are lots of jobs available, employees are much more likely to quit. And of course, lots of jobs available means there's more upwards wage pressure. And the employee quit rate here is the highest it's been by a significant margin in the whole of the 21st century to date, which suggests that there is indeed quite going to be significant upward wage pressure.
Now, this is a chart that's been going around for a long time, but came up again on Twitter, and it purports to show that actually US inflation is merely a function of the birth rate. So the birth rate is the dark blue line, and inflation is the yellow line. However, Richard and I are deeply skeptical about this, because essentially this means that, you could print as much money as you like, you could borrow as much money as you like, and, the Weimar hyperinflation would never happen.
No, this is a single factor correlation on a very complex subject. And also it doesn't take into account various as Keith says, idiosyncratic actions at different points in time. For example, where was the pandemic in the period between 1950 and 2020? Well, there wasn't one. And so clearly there is some sort of a correlation there, and the fact that there's a correlation makes some sort of sense. But I think to extrapolate it and not interpret it very carefully is a dangerous thing to do.
Yeah. Now, in the US, the blue line is lumber prices, and you've seen they have really come back down. So, there's a lot of speculation in lumber prices.
They have, Keith, but they are still 3 times what they were a year ago.
That is all true, but I don't think there's fundamentally much of a shortage of lumber. There have been bottlenecks, and I expect maybe it will rise from its previous pre-pandemic lows, but I don't expect it to stay twice the price. But the point of this chart is that those high lumber prices had a big effect on consumer confidence, and the red line is consumer confidence in buying a house, so buying conditions for US consumers, and they collapsed. But that collapse in house buyer sentiment, which is the red line, was not matched by a collapse in house builder sentiment. So builders remain confident, but buyers seem to be reconsidering. Will the 2 lines come back together?
Yeah, and what does that do to the building companies if they are busily building vast quantities of houses that home buyers actually don't want to buy at the moment?
Precisely. And this chart just shows the amount of... Actually, what does this show, Richard?
Well, this shows... So I think it shows a couple of things. One is that the US Federal Reserve has actually increased, I think, recently, the interest rate available for reserves deposited at the Fed. And it also shows that the whole financial system is totally up the spout in some weird way. And how do you interpret this? It's like goodness only knows what's going on.
Well, it's just loads of cash sloshing around the system, searching for yield.
Yeah.
Now, I thought this is a very interesting chart, but one that, frankly, we think should be treated with some caution, because we have no idea how the gold line, the orange line, which it purports to show global liquidity, we have no idea how that's been calculated. But what it purports to show is that there is a strong correlation between global liquidity conditions and wealth. These are year-on-year growth rates. And what it's showing is global liquidity conditions are tightening, and with the clear implication being that the rate of wealth creation should slow. But then, frankly, the rate of wealth creation last year was absolutely extraordinary. So,
and also, presumably, this is the wealth. All wealth is measured in dollars, which are being created at an alarming rate.
Yes, that's a good point, Richard. I mean, there's quite a lot of questions about this chart because they don't actually state how they measure that, whether it's real or nominal.
The dodgy wealth creation chart.
Yeah. Now, one of the surprising things about last year was during the recession, there was so much stimulus that bankruptcy rates on both sides of the Atlantic actually fell. So this is US bankruptcies. This is bankruptcy cases going through the courts. I mean, it's extraordinary. They actually fell 40%. And this is in the UK. I mean, do we have a load of zombie companies just being kept alive?
I think so. So these two graphs, the small business open and small business revenue graph for the US, show that number of small businesses open hasn't improved for the whole of this year for effectively nearly 6 months now. That contradicts, as we've discussed before, some of the good economic news that is coming out of the US. And the small business revenue chart, Keith, is the next chart, is in a similar sort of situation where it is not actually improving. So, and it's currently 30% below pre-pandemic levels. So we still have this huge contradiction between this data, which suggests small businesses are in a bad way as a group, and other data which suggests they're not. And I think the bankruptcy data is very contradictory vis-a-vis this data. And in the UK, of course, they're all being supported by the furlough loans and the
yes, exactly,
loans.
Going back to this chart, Richard, I mean, what I find very worrying about this chart is the shape. It is not improving. It's continuing to deteriorate, which suggests actually US small businesses are closing now. They're opening up, perhaps because, you know, the stimulus checks are failing to come through now.
Yeah.
So some of these zombie companies are closing, in which case then you expect a continued drag on the US economy.
So yesterday on the news, I heard a statistic for UK free school meals, and I missed where it was, but it was clearly in a relatively deprived area of the UK. And this school had previously had 27%, I think the number was, of its children were entitled to free school meals, and now that number is 38%. And that's a 30% increase in the number of children entitled to free school meals, which means effectively a 30% increase in the number of households who meet the poverty criteria for their children to be in receipt of free school meals, which is a very poor sign for the health of the economy.
But real interest rates are at an all-time low, I would say, outside of a recession. I mean, the only other times you get real interest rates this low are during recessions.
This must explain why the price of gold has fallen 5% in recent days, Keith.
Yeah, or not. See, I mean, it's extraordinary, absolutely extraordinary, the amount of stimulus we have at the moment. And everywhere there's a lot of cash sloshing around the system, and it's searching for yield anywhere. And this is the yield on high yield US corporate bonds, and you'll see that it's the lowest it's been since 2007. And you know, 2007 ended in a financial crisis. You know, the period before 2007, there was huge amounts of malinvestment, and we are essentially incentivizing loads amount of malinvestment now.
Yeah,
with artificially low interest rates. And on that note, junk bond yields are now negative. Extraordinary. Okay, moving on. Now, one of the things we have discussed several times in the weeklies is the supply bottlenecks, and one of the reasons we are getting inflation is because goods are not being able to move around the world. And we have previously talked about how that has been a function of COVID disruptions at ports. Now, I saw this chart during the week, and I questioned whether our previous narrative was correct, because if you look at the blue line, these are inbound containers at Los Angeles and Long Beach, and actually they are really high. They are 25%, so almost 1,000 over previously below 800. They're 25% higher than pre-COVID. And so actually it might not be COVID disruptions, it might be capacity constraints. We are trying to remove vast quantities of goods around the world, and the ports perhaps don't have the capacity to deal with them, in which case supply chain disruptions may be much longer lasting than we had been expecting.
It's also indicative, Keith, I think, of the potentially parlous state of the US balance of payments, because the loaded out is dropping, the loaded in is rising significantly.
Yeah.
Which means exports are dropping.
Yes, that's true. Goods exports.
Goods exports, yeah.
And finally, in this section, further evidence of the total inability of US private investors to time the cycle. So this shows the flows into various different asset classes over the last year. So TTM is trailing 12 months. You see that over the last 12 months, private investors took 108 billion out of US equity funds, and they put 785 billion into taxable bonds. Yeah. What do you do? Okay. Moving on to the equity markets. So it was generally quite a poor week. FTSE was down 0.1%. The S&P was down 0.4%. The NASDAQ was up 1.4%, which is, I find, surprising given that yields rose. Topics, the Japanese index was down 0.4%. Bitcoin was up 2.7%. And sterling was down 1.7% as the dollar rose strongly. Moving on to industrial commodities, and it was a very mixed week. So aluminium was down 1.3%. Cobalt bounced. Cobalt bounced strongly, up 9% on the week. Copper had a poor week, down 4%. Chromium was flat. Iron ore is amazingly resilient, up 3.3%. Lithium and neodymium were flat. Nickel fell along with copper. Ferrovanadium rose 4%, and so iron and iron inputs are doing well at the moment. Oil had a very volatile week. It was up strongly in the early part of the week and then came off again. And coal had an absolutely extraordinary week, up 7%, and we have added coal to the weekly checklist. Uranium was flat. Richard.
Oh, well, so this is a view of the S&P 500 with the what happens if it mean reverts. I'm not sure there's any particular danger of mean reverting anytime soon with the amount of money that is being pumped out by central banks. But it is a warning to be really careful about what's going on and not to be overexposed to this. And I mean, you can see that the dot-com bubble, the housing bubble, basically the market dropped around about 60 to 70% on each occasion. If the same thing were to happen now, you'd go from 3,400 to around about 1,000. And history suggests that it should happen at some point. Whether what the catalyst is, I don't know. But I think it's important to have this always in mind.
Yeah, I mean, frankly, Richard, I just see no danger of this at the moment. Touch wood. The liquidity conditions are so lax, and central banks are so supportive of asset prices.
I think that's the point, Keith, unless we get more than transitory inflation.
Yes, that's right. Okay. So having talked about equities, let's talk about commodities. Well, this is the ratio of commodities to equities, and you'll see there is a cycle here. And the question is, now commodities have started moving, how far back can they move? And this chart would seem to suggest commodities have potentially a long way to run. Now, moving into the chart, so this is crude oil, which has had a fairly flattish week, but this trend is very strong. So from November last year, it has been moving relentlessly upwards. And let's spend a bit of time on oil. So one of the things we've covered regularly in the weeklies is how nobody is investing in future oil supply. And that is continuing. So the US oil majors and oil companies are still not investing in future supply. They've cut capex, and actually their capex expenditure in 2021 is down on 2020, when oil prices were much lower than they are now. And this all presages an oil supply shock or constraints going forward. And if we look at the oil cycle, So the oil cycle is the capex cycle. So if you invest in, when the oil price is high, everyone invests in future supply, and then 5 years later, there's loads of supply, the oil price crashes. When the oil price crashes, then nobody invests in supply, and in 5 years' time, there's no new oil supply coming on, and the oil price goes through the roof. So if we look where we are in the oil price cycle, inventory levels are actually back to historic lows, so norms, and falling. That is all very bullish. So that's saying the oil supplies are tight and nobody is investing in future supply. So frankly, the oil cycle looks very strong at the moment. And if we look at inflation adjusted oil prices, then oil potentially has a long way to run. Now, this is an interesting chart from John Kemp at Reuters, and it shows the daily oil production by different groups. So OPEC are currently producing 31.7 million barrels a day in June. In January 2020, they were producing 33.9. Now that is only 2.2 million barrels lower than 18 months ago. Now, you remember that OPEC are saying they have spare capacity of 6 million barrels. I mean, this is suggesting their spare capacity is much lower than that, with the clear implication that the market is tighter than we might think. And when we talk about the lack of capex and investment in oil supply, this is the number of oil rigs drilling for oil in the US, in the shale patch. You'll see oil prices have shot up, but the rig count hasn't. So there's been uncharacteristic discipline. People are not investing in future capacity, which matters because oil is the economy. Now, this shows the correlation between oil liquids, so that's petroleum and crude oil and all oil products, and world real GDP growth. And the correlation is incredibly strong. The regression has an R squared of 98, 0.98, 98%. So the causality runs both ways, but the oil is the economy.
In reality, what this is actually saying is that the correlation is between energy consumption and real GDP growth, and our energy is mostly supplied by oil. And if we wish to move away from oil, we have to provide at the same pace as we move away plus increases in real GDP, we need to be substituting non-oil, non-fossil fuel-based energy. Otherwise, real GDP will fall.
Yes, precisely.
We're not able to do that because we simply don't have the capacity to substitute significantly yet. But we're not doing the exploration, and we are going to reach a large crunch where basically there will not be enough oil to sustain the economies as they currently are, and there will not be a substitute. That's the danger of where we're heading.
That is my investment thesis, nicely summarized, Richard. Thank you.
Pleasure, Keith. But when the lights go out, you won't know the value of your portfolio.
So I say that again. When the
lights go out,
oh yeah,
you won't know the value of your portfolio.
Yes. And on that note, this is US oil inventories compared to the so left is crude gasoline and distillates versus their 5-year average. You'll see they're below its 5-year average and still falling. And this is just crude oil alone versus the 4-year average. Again, below and falling. This is all very bullish. Okay, moving on to coal. Richard?
Well, Keith, the price of coal has gone up by 140% since September or so last year. And of course, coal is reviled, rightly so, actually, in terms of the damage it causes to the environment. But it is used for power generation and for steel production. And you can't switch off coal-fired power stations without having a significant drop in real GDP, as we've seen from the previous graph.
Well, this is further evidence, Richard, that of my total inability to predict the future, because I bought all the ESG arguments about how we were going to stop using coal, and I intentionally avoided buying any coal companies. And what a fool I was. Look at this. I mean, this basically is a real eye-opener about showing how ineffective the switch to renewables has been, because suddenly, essentially, we need energy, we need coal, and people are massively bidding up coal. I mean, the shape of this chart is the long-term price of the coal is extraordinary. You know,
it is, isn't it? And it's not going to, the actual coal consumption won't change anytime soon unless countries want to turn out the lights.
Well, I think in the US and the UK, we are certainly getting rid of coal from the energy mix. But what this is saying is supply is coming on stream slower than we're getting coal out of the mix. So there's now a constraint.
China is a very large consumer of coal. Germany switched off its nuclear reactors and substituted coal-fired energy for a lot of its electricity production, and is frantically trying to move to renewables.
Yeah. And in the meantime, they're burning lots of dirty brown coal.
Yeah.
Copper. Now, copper had a bad week, but you know, there's quite a lot of speculation. I think this is intact, and as regular viewers will know, we like quite a lot of copper companies like Rambler, which have had a bad time recently as copper's come off. But I'm simply relaxed.
If you draw a straight line underneath the low points, the current 4.2 is around about touching that line, Keith.
Yeah. Okay.
Take my word for it.
Okay, thank you to James Battle for putting us onto this. But anyway, China have threatened to release copper from their strategic reserves. And they're saying there's too much speculation, the copper price is too high. And the question is, how big are China's strategic reserves? And for copper, they have around 2 million tons, aluminium 800,000 tons, zinc 350,000 tons. These are all numbers for CNBC. And world annual copper demand is about 28 million tons. So actually, that's quite substantial. That's about, I don't know, 7 or 8% of world.
One month supply, Keith. But the issue with it is they wouldn't want to release 2 million tons, would they? Because they wouldn't have any reserves. They might release 500,000 tons, which would be 1 week's supply. And okay, so take the top off. Absolutely take the top off the speculative bubble. But we also know that we're in a long-term deficit situation in it. And it's a little bit, I suspect, as we were discussing earlier, it's a little like the Federal Reserve talking up interest rates without actually changing them. And I think China's probably talking down commodity prices without actually releasing any of its strategic reserves.
Yes, that's my thought exactly, Richard, because the Chinese are also well aware that there's a copper super cycle going on, that there's short copper in the future. And, the chance they're going to sell all of it now, I think, is very low.
In fact, they probably want to buy more. They quite like the price to drop so they can buy a bit more.
Okay,
cynical?
Sorry?
Am I excessively cynical?
No, I think you're spot on. Right, aluminium.
Another straight line there, Keith. If you draw a line underneath all the low points, you pretty much get back to 2,400.
Yeah, no, I agree. Cobalt picked up, and frankly, this is the sort of shape of chart I expect to see quite a lot. So lots of speculation, very rapid rise, and then sell off until all the speculators got sold out, and then the share price starts to pick up again. Iron ore continues to absolutely amaze me. This is a straight line. Nickel sold off. As we have discussed before, there's actually a surplus of nickel over the next few years. So unsurprisingly, prices are a bit weaker than the other commodities. Third, vanadium had another really strong week. Precious metals all had a shocker on the back of rising US dollar. So gold was down 4.5%, silver down 6.5%, platinum down 7%. These are big numbers. Rhodium actually recovered slightly. Palladium down 8.5%. So we look at gold. I mean, that's quite a big sell-off.
Yeah.
Gold now down back below $1,800. Yeah. Richard.
So I just wanted to talk about this. There's quite a lot of speculation going around about the effect of Basel III banking regulations and gold. And I just thought it'd be interesting just to cover it fairly briefly. So Basel III was launched in 2009 partly in response to the financial crisis, with the aim of ensuring that banks had sufficient capital liquidity and less leverage in order to be able to withstand economic shocks, so that we didn't have a repetition of having to bail out globally systemically important financial institutions again at some future point. So these new rules come into effect that relate to gold and commodities, actually, not just gold, but commodities, on the 28th of June for European banks and 1st of January 2022 for British banks. And there are three main parts. Banks must hold increased capital. That makes them more stable in the event of unforeseen financial circumstances. They have to maintain a minimum leverage ratio of above 3%, and they face higher liquidity requirements. So they've got more liquidity available to offset any shocks. So it makes the banks more stable, less vulnerable to systemic shocks by increasing their reserves against derivative contracts. So the next slide.
So Richard, before you carry on, when you say minimum leverage ratio above 3%, what does that mean?
It means that their reserves, their gross assets, shouldn't be more than 33 times their reserves.
I thought that's what it meant. Isn't that an absolutely enormous number?
Yes. I mean, it means that a 10% reduction in their gross assets wipes them out.
Yeah.
They are hugely vulnerable. But, you know, somewhere like Deutsche Bank, I think it has a leverage ratio of 125 or something.
Yeah.
So what Basel III is, one of the things Basel III has done, I think it's a very complex piece of regulation, but one of the things it's done is it has defined physical allocated gold held by a bank as a tier 1 asset, which is zero risk or considered a cash equivalent. So basically, a bank can hold as much gold as it likes, and it doesn't have an effect on its reserves. It doesn't have to reserve against its gold holdings. It has to be physical, it has to be provable. So the existing rules, before Basel III comes in, if a bank had unallocated gold, they did not have to reserve against it. So it had no impact on their reserve ratios. But Basel III now says that if a bank has unallocated gold, they have to reserve 85% of the value of that unallocated gold. So for the sake of argument, if they had $1 billion of unallocated gold on their balance sheet, i.e. it's not physical and it's not provable, then they would have to increase their reserves by $850 million. And that is a significant cost to a bank. So it is less likely to want to have unallocated gold on its balance sheet. So consequence of that is that the trading, clearing, financing and settlement infrastructure of unallocated gold becomes much more intensive of the use of a bank's reserves. And if a bank can make a return of 2% or something on its reserves, it has to take a large chunk of those reserves and apply them to unallocated gold, and it can't make the return on its reserves, it won't do it because it'll get a better return elsewhere. So it's basically forcing them from an economic point of view to use their reserves not for it's putting a charge against the bank's reserves for holding unallocated gold on the basis that unallocated gold isn't available to the bank immediately should it need it in the way that allocated gold is. So that means that some bullion banks may have to change their unallocated gold business. And what are the implications for the gold market? So the theory is that by significantly increasing the cost of dealing in unallocated gold leasing lending, a substantial chunk of unallocated gold will be removed from the banking system. Why does it matter? Because it's thought that much of the unallocated gold in the system is actually multiply rehypothecated, either by multiple lending within the banking system or by central bank leasing. So let's say a central bank leases out 1,000 tons of its gold into the banking system. It has the 1,000 tons of gold in its vault. It doesn't move. But the banking system says we also have 1,000 tons of gold, but they don't. They have the leased gold from the central bank. And then the banking system then says, we will sell this gold to our customers as unallocated gold, and we'll tell them that we've got their unallocated gold. Well, actually that unallocated gold is being used twice, once by the central bank and once by the customer who thinks they have it.
Yes.
So this rule will remove an element of unallocated gold from the system, which means the customer will either have to say, I want physical gold, allocated gold, or I don't want gold. Unallocated gold becomes not an option unless they are charged whatever the appropriate charge is for the bank to reserve against the unallocated gold. So the theory is now that unallocated gold gets squeezed out of the system and demand for physical gold goes up to replace what people thought they had but didn't actually have was allocated gold.
So the bottom line, Richard, is that by removing the double counting of gold, you are going to essentially cut supply. And if people want gold, they're actually going to buy real gold rather than paper gold. Yeah. And that's bullish.
Yes, that's right.
Right. Great. Thank you.
That's a pleasure. So it doesn't just apply to gold, it applies to all physical assets, all physical commodities. But the one that is most seriously affected, I think, by it is potentially affected by it is gold.
Great.
That's on this slide.
Okay, so silver is traditionally geared to the gold price, and this week has very much seen that. So silver fell very heavily. Platinum also sold off strongly, and that actually is looking not as happy as the other charts.
It's not, is it? And I mean, I wonder whether part of that is to do with speculators coming out of catalytic converters, you know, the end use of platinum catalytic converters. And I'm minded of the speculative interest in commodities graph that we showed the last couple of weeks. And be interesting to see if we can get an updated version of that in a couple of weeks' time to see whether the speculative interest has dropped.
Yeah. Rhodium seems to have bottomed, actually. That's looking a stronger chart. It's too early to tell. Palladium also come off strongly. Okay, so moving on to rates, and it was, as we've talked about previously, an exciting week in the rates market. So you'll see that when the US Fed started talking up the possibility of a rate rise in 2023, short-term rates rose strongly. So the UK 5-year yield rose. But then, because the market took that as an indication that the Fed and central banks remained in control and were concerned about rising inflation, long yields actually fell. So the rate on the UK 30-year gilt actually came down. Yeah. And this is the UK 30-year. Seems to have topped out for now. 30-year, 30-year. 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 30-year And to give you an idea of just how daft the world of interest rates are, the Greek 5-year bonds have turned negative. And to remind viewers that since its history as an independent nation, Greece has spent more years in default than it has actually repaying its government bonds. And this is the Richard, do you want to talk about this?
Yeah, so this is a long-term graph of the US 30-year yield, and it shows that it is still within a downward trend. And if it sticks within this downward trend, it may actually go up to near 3%, but it's heading negative if it stays within this path. And I see no evidence to suggest it's not going to do that.
Well, if inflation picks up, Richard, all bets are off.
I don't agree, Keith. I think the central banks will have to keep yields very, very low indeed, because they'll kill the economy if they raise them. Wow. That's what all this is about, isn't it? That's why they're talking about tapering.
Yeah. Well, the thing is, I think at some stage they lose control of the long end.
Yeah, they're completely trapped. I mean, it's.
This is the US 10-year. And finally, this is the seasonality chart, which actually regained some of its composure. It said we're going to have a bad week, and we had not such a bad week. But, it's an extraordinary year.
Certainly is.
Right, Richard, do you want to go through your activity?
Thank you, Keith. So this week, not a particularly good week for me. Down 1.3%. The only change was I purchased some Teresa after your very interesting share talk the other day. You convinced me. So I also own Jubilee in Sylvania. No sales. And I won't go into Teresa because obviously we've covered it very recently. So that is my weekly update, Keith.
Very good, Richard. So like you, I had a poor week, down 0.6%. That takes me up to 6.9% on the year and underperforming the all share. So I sold a couple of stocks during the week. I sold my Chevron, which had just not been going anywhere and been underperforming other oil companies. And I also sold my Standard Chartered. It was the weakest of the banks. And frankly, we have covered a few interesting companies on Share Talk, and I wanted to free up some capital to invest in them. So I bought, with my usual great timing, some Phoenix Copper, only to see it fall literally 5% the day after. I bought some Teresa. I bought some Ares Strategic. Again, it promptly fell. And for better or for worse, Richard, I'm absolutely sticking with my enormous oil position. In fact,
you've increased it.
Yeah, I bought some dodgy stuff. So Valaris is a drilling exploration company. So it provides drilling rigs, and it's come out of bankruptcy.
Right.
And, it's buy the crap, basically. If the exploration comes back, shares could fly. Although I bought it and the shares promptly fell. And I also increased my position in EnQuest.
Well done.
So this is Phoenix. I bought it here. So in the days leading up to this, I had a limit order on, which never got hit. And I thought, this is going to go away from me. I better buy some. So finally I did, promptly fell. This is Ares Strategic. I bought it, promptly fell.
So you shouldn't have done the share talk on it, Keith. Everyone sold it as a consequence.
Yeah. And this is the story of my year, basically. So as regular viewers will know, we did a share talk on Hunting, which provides drilling equipment, mainly for the US shale. And the orange line is the oil price. The blue line is Hunting, which I really like. Oil up, Hunting down. That's it. Frustration. Anyway.
Fingers crossed, Keith, that the oil sector will start to move ahead as more and more people begin to appreciate what sort of an oil shortage we're heading for.
Well, the thing is, Richard, my central thesis is, I buy oil companies because I think I can have a good idea about the oil cycle. But there is the assumption that oil companies' share prices are going to follow their profits, which depends on the oil price.
Yes.
If they don't, then my whole thesis basically falls apart. And right now, oil companies' profits are going through the roof and the share prices are going nowhere or even going down. I mean, how does that work?
They need to start declaring dividends on their profits, Keith.
They do.
And you'll be okay. Great.
Okay. Well, thank you all for watching. And please can you press subscribe and like. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.